what people may not realize was the New Zealand stock market actually was the best performing stock market in the developed world for the 10 years up until about 3 years ago.
Really?
So every year it's kind of random as to which country performs really well, which sector performs really well. And so by spreading your investments across stocks and bonds and sectors and countries, you're ensuring you're going to get a good long-term outcome.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got Dean, founder of Kernel, on the podcast to talk to us about if the S&P 500 is a diversified fund.
We are back in your life. And Dean, you are back in our life. Great to get you back in the seat.
Morning, gentlemen.
We are pointing and we are yelling.
Ready.
We are fired up about the S&P 500.
We are. Now, Dean, I get asked this question all the time.
Mainly by me.
From the finance bros, from the index lovers out there, for the DIYers going, why don't I just put all my money in the S&P 500 and leave it alone? I think Warren Buffett gets quoted a lot in this space going, that's all I would do. What are your thoughts?
It's like the pinnacle fund for particularly index investors that everybody's referred to. It's got a really long history. So, the big famous S&P 500 fund, the SPY, launched 1993. So there's decades of this history. It's the biggest index fund in the US. One fund, the SPY, is 3 times the size of our entire New Zealand stock market, that single fund. So these are popular, well-known, long history funds, and they have proven to be really hard to beat from active managements. So it's no wonder that people gravitate towards them. And now they've kind of become the go-to reference point for any personal finance blog, book, etc. that you may read. And so investors love to look at that as the go-to. I guess the big question is, particularly New Zealand investors, is that where we should be investing? Should we be putting all of our money in the S&P 500, or should we diversify more in what makes up the fund?
Yeah. So as the non-investment guy out of the three of us, I'm on the debt side of the ledger. I'm going to ask some questions. James, what is an index fund and what actually is SPY or the S&P 500?
I think this is Dean's world.
Dean, go on then.
An index fund or an index basically just measures the collective basket of some assets.
Cool.
So you can have an index on anything.
Yeah. On us three?
Yeah,
Nice.
It could be measuring your heights and weights over time, whatever it may be, right?
Mike, you have been dragged up. Congratulations.
And so they've been around actually since the late 1800s.
Yeah.
And an index just measures that collective performance. And now there's a million different indices around the world. You get all sorts of flavors and colors that you like. And so the S&P 500 is measuring the performance of the 500 largest companies in the US.
So 500 largest listed companies in the
companies,
US.
yep.
Cool.
And so the bigger the company in that index, the bigger the percentage weight it has in the index itself.
Right. So if you've got, say, 100% is the entire
pot.
portfolio, Meta, Facebook would have a larger slice of that pie than, say,
So they're a more valuable company. They sit higher up the ladder. And so Meta has a bigger impact in the overall performance every day because they make up a bigger percentage than, say, company number 500 in the list.
Like in and out there.
Yeah. And so that's an index.
What's happening to the overall weightings over time? So there's obviously the stat that the amount of time a company is spending in the S&P 500 is dropping more and more over time.
Yeah.
But is the S&P 500 also becoming less diversified, or have we always had those really big companies and the smaller ones?
So what we talk about, and what I'm sure you guys and everybody talks about when it comes to good investing habits, is diversification. And diversification can get interpreted in a number of ways. For some punters out there, they may be playing around on a trading platform. Diversification to them means, I need to buy every single fund or every single stock. That's not the case. When you boil it down, what you want is to have a mix of stocks. So you don't just want to invest in one single company. So S&P 500 ticks that, right? It's 500 companies, so it's diversified. You want to have a mix of sectors. Like, you don't just want to be invested into the construction sector or tech. And so again, S&P 500 invests across a broad range of all those sectors. You also want to be diversified across geographies and countries. What people may not realize was the New Zealand stock market actually was the best performing stock market in the developed world for the 10 years up until about 3 years ago. unperformed.
Really?
So every year, it's kind of random as to which country performs really well, which sector performs really well. And so by spreading your investments across stocks and bonds and sectors and countries, you're ensuring you're going to get a good long-term outcome. And so the question mark where people start going, well, is the S&P 500, is it diversified enough? And should I just put all my money in there, particularly because it's US only? And that's sort of a big question mark because the US makes up about 25% of global GDP. But the stock market makes up 70% of the developed equity markets.
Wow.
So you go on that and say, well, actually, by investing in the US, I'm actually invested in most of effectively the world stock markets anyway. It happens to be domiciled in the US, but these are companies that we all use everywhere around the globe, that the products that we buy from Coca-Cola to using Facebook. So it's kind of global. It just happens to be that they're American companies. So in one lens, the S&P 500 is a fairly diversified asset. But then you do see some other things that have happened recently, which we haven't seen in 50 years, which is the concentration of those top 5 companies. So the 1% out of the 500 is now quite high.
Yeah. And what are those top 5? Like probably Facebook, Apple.
That's got your Alphabet, your Amazon, and I should know this, Apple and
Fang?
Nvidia
in there now as well. Sorry,
yeah. And commonly known as the Magnificent Seven. Those really big tech companies just continue to grow and take
So the 5 make up over 25% now. Top 10's about 35%. So
So
while you're diversified across 500, you're actually still concentrated in quite a lot. Now, we haven't seen that since the 70s. So it's quite concentrated. And the big difference as well between when it was as concentrated back 50 years ago was 50 years ago when we had so much in the sort of top 5, top 10 names, they were all in quite different sectors. You had like Exxon and IBM, so energy and tech. Whereas now they're all kind of fairly concentrated into technology-related spheres. So if something happens in terms of an AI bubble or a big tech gets broken up by regulation, etc., you're quite exposed to one kind of theme at the moment.
Yeah, and if you look at the last few years, obviously there's been a huge run on those tech companies and their growth. There's a stat on Nvidia employees, and I think it's like 1 in 3 of them are now a millionaire or something like that because they've got shares in the company, and then 1 in 5 are worth X amount more. So these companies have just gone crazy, but it does make you quite short-sighted because I'm sure a lot of people would be surprised about the New Zealand stat. They're going the previous decade run because you look at the last 3 years and the NZX has gone absolutely nowhere.
Yeah, exactly. So if you come back to it, like particularly the fact that we're in New Zealand, I think while S&P 500 is a great fund for somebody to have in a portfolio, it shouldn't be the only thing. And you have to remember that there are always unknowns. And one of the nice things about an index is if you own the S&P 500 or you own a US index over the past 100 years, the performance of certain sectors chops and changes. Railroads used to dominate the index, but then technology has surged. The nice thing about an index fund is that you just naturally own more of the things that start performing better. So you don't have to worry about that too much. But from an investor point of view, having some diversification outside of the US is quite good. It helps protect against all the unknowns that may occur from natural disasters to geopolitical issues, etc. And so that's where people start to actually look at more broader global index funds rather than just the S&P 500.
Yeah. What are some of the headline like global index funds?
So there's quite a few, and we offer several ourselves. So we've got a developed equity index. We've got a global 100, which is kind of the global 100 is really interesting. It's kind of like the S&P 500 version of a total world index. It's 100 of the largest global companies, not just US. So it's still quite concentrated to the US, but it makes up a large part of the developed equity market. So you still get some of the other markets that, people don't always think about.
I just imagine that. I just think with the global 100, the in Scooby-Doo where they've got the mask and they pull it off, and it's just the S&P 500. Like what percentage of the global 100?
It's still about 70% US, which is about, as I said,
but we said that's
about what the equity market,
Yeah.
the developed equity market weight of US is. So you're spreading a little bit outside. So that diversification thing is really interesting. And I think it's one to watch. And, there's also the big thing that's coming up in the next 4 weeks of the US election. And so we're going to have a lot of people talking about the S&P 500 and what the US election means for index investors and the market going forward as well.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below.
One thing I was thinking about with the US component, obviously a very divided country, lots of potential things that could happen over years to come, is the fact that these companies are so global means that they're a divided country doesn't matter, doesn't impact the fact that the S&P 500.
I think this is going to stretch my knowledge base, but top of my head, I think about 19 or 20% of the earnings come outside of the US.
Yeah.
So still global, right? So there's still a large component that is global, and it will depend on various sectors, right? Some sectors will be more global than others. The Global 100 index actually has a criteria that the companies have to have at least 30% of their assets international and 30% of their revenue international. So it is kind of forced to be you are global players. There's still quite a lot of external exposure. And that's interesting because your point, US right now, incredibly divided, and you see certain political events blow up and all of a sudden Target may be boycotted by half of the US population or Budweiser, etc. Those things can happen pretty quickly in a matter of a few days, right?
And coming back to the diversification piece, I mean, we know when COVID hit, how much money moved from aggressive funds down to cash funds because people weren't fundamentally comfortable or understood volatility when it came to investment. Whether it's S&P 500, the ASX, NZX, whatever, fundamentally it is just all shares. And that means that, it can drop substantially. So while the diversification piece is there, there's also the question around risk profile and going, do you actually understand what can happen with this investment, regardless of if it's a good diversified investment or not?
Exactly. And that comes back to exactly what we open with, which is you need to be diversified. And the risk profile, like if you guys are speaking to somebody that's planning to buy their home in the next 2 years, you probably don't want to, or the next 12 months, you probably don't want to have all your money sitting in the S&P 500 right now.
How often do you run into that sort of thing where people are putting their money into, high risk assets when they've got a short-term goal of buying a house?
Fairly regularly. And it's usually that people don't understand the risk of the asset if they're doing like their own DIY investing. Most people get that a high risk KiwiSaver fund is high risk because it is labeled high risk or growth. But they will still leave it in there because they see KiwiSaver as just being something that goes up over time and safe. It is actually when people pick direct shares that they think that is low risk because they see the company as low risk, right? Like they might go, Fisher and Paykel, that's a low risk company. They make healthcare. They make
in New Zealand.
Yeah,
it used to be $3. It surely is going to be $3 again. Right?
Exactly right. And what they don't understand is that the actual shares or share market is riskier than what they perceive.
I think the other big challenge with that is we have really short-term memories, and people forget. Like in COVID, while it had a big impact on the market, it was a fairly short and sharp. Like it was a really quick drop and then a quick recovery, and a lot of people started investing after the drop, so they don't actually have a long-term, scarring or experience of maybe what like various downturns of particular countries or markets look like. And so when you've got somebody looking and going, the S&P 500 seems to just smoothly tick along. It's up 20% so far this year. Why would I not? It's not risky. It's just a safe investment, right? I think it's easy to forget that, there is volatility. Things do go up and down. It's not a straight line that you just keep making money every year consistently in share markets. You have to take on risk to get the reward. And when you're planning to buy a home, you've got to be conscious of that and not just look at the last 6 months and go, I made 20%. That'll be fine. I'll do that again.
Yeah, where I see a lot of the times it's people not understanding the risk. Where I see the actual cognitive dissonance is crypto, because people want to believe, so will just believe that it is lower risk than it actually is, and that the returns are much more certain than they actually are.
Yeah. Cognitive dissonance. That is
Dissonance.
I can't even say
you're
it.
putting a T, a T, where there's a
Very impressive that I'm just not gonna, skim over the fact that you dropped that in the podcast. Very impressive, Mike. IQ points went up. Obviously with interest rates moving up, there's a period of time where it didn't go very well for bonds, but they are a much more attractive asset. And also in the property space, like some of those property funds took an absolute hiding. Like if I look at how much, I think like the NZ commercial space in particular has dropped. The NZX hasn't performed very well. You might be missing out on other opportunities.
This is a really great example. And we actually wrote something on this last month, looking back at the last quarter actually, of these less sexy investments. People just obsessed with tech and the thing that's been really shiny for the last 12 months. But having some non-sexy investments in there. So we did a piece looking at global property and global infrastructure. These are fundamental to our day-to-day lives that nobody really thinks about from an attractive investment like retail investors. It's all about big tech.
AI,
right?
But you take AI and it's,
the last quarter, global property and infrastructure absolutely smashed out of the park. Like I think they're up 15% plus for the quarter type stuff. And while at the same time, there was a lot of volatility in US shares, and US shares were down, global shares were down a bit. And so having a bit of that in your portfolio would have offset some of that. And same with bonds, a balanced fund that has some bonds and equities performs really well and has less volatility and less ups and downs than maybe just going all in on S&P 500. So it's much better out there today, I guess, post interest rate rises, that you can diversify across a range of different types of assets from property and bonds and shares, and together they can be quite a powerful combination for your wealth building.
Yeah.
So the question has been answered. The S&P 500 is not a diversified fund. Dean, I want to finish on one more question. If the answer is so obvious, why do you think Warren Buffett goes with that kind of line? Because he's got so much power in terms of what he says. Why do you think he is saying that?
Again, people need to dig a little deeper, right? A lot of the stuff that we read out of the US is centered for US investors. So it's like the same way we talk about people having a home bias here. So without opening up that big can, a US investor naturally should invest more into the US market. And Warren Buffett is a big fan of index funds. Now, when he talks about leaving some of his estate and telling his wife to put that to an index fund, you need to remember that's actually still only a relatively small percent of his total asset pool. It's not 100%. So, when you actually read into what he's structured, yes, there is a good allocation in terms of dollars into S&P 500, but he's still diversified in a lot of other assets. There's still insurance exposures and everything else. So, he is more diversified than just putting it into the S&P 500, as his tagline may perceive to many readers.
Yeah.
Does make me think, though, the home bias would be another great episode. So if you are interested in us doing an episode on whether should you have exposure to New Zealand assets within your portfolio, put in the comments NZ, and then we'll get Dean back for another episode. Dean, thank you very much for joining us.
Thank you.
Thank you to Partners Life for sponsoring this episode. Please subscribe to the podcast, give us a review, give us a like, and we'll catch you next time.
Cheers.